From our studios in Scottsdale, Arizona, this is Retirement News Online. Managing risk in retirement and income planning is crucial for ensuring financial security and a comfortable retirement. Now, it involves understanding the potential risks and implementing strategies to mitigate their impact. And here to talk about, once again, for our second interview is Andrew Johnsen. He's a financial advisor and a retirement planner and a savant in this area in Dallas, Texas. Andrew, how do you protect retirement income given that we've got like market volatility, we've got all this inflation, and we've got things like sequence of returns risk, which is something that is related entirely to timing? How do you handle all that?
Well, I'd say market timing is the great place for us to start, right? I think people love to be very concerned in times where the market is highly volatile, and they seem to not really care all that much when the market's doing well. But I think that timing is everything, but also it's about kind of keeping that ballast, that level-headedness when it comes to investing. So that's kind of the first psychological input of investing is saying, hey, how can I create a plan that's formidable in terms of volatility in times when there's not volatility? So that's the first thing I wanted to touch on. I think just protecting sequencings of returns, that really comes down to great portfolio design. So understanding your entire risk profile is going to be the most paramount thing that you can think about when you're an investor. So doing the steps to say, hey, am I okay if the market's down 20%? How much am I able to be down when the market's down 20%? If the market's up 20%, how much do I want to be up? And educating clients around those particular facets are really important. And then beyond that too, I would just say protecting income is really about asset location and understanding an advisor who has a very good pulse on the market and knowing when to shift from risk on assets to risk off assets.
And we've just seen some upheaval in the market. We've kind of come back a little bit, but obviously you saw a lot of panic selling. And then you become a behavioral psychologist because you know what you're typically supposed to do, but how do you convince a client that, hey, wait a minute, let's not start selling everything right now. Let's make sure that we at least have a chance to recover if it does happen. How do you have those conversations?
Absolutely. Well, as Warren Buffett said, the market's the only market when the prices go on sale, all the investors run all the clients run for the door, right? So I would say that it's first and foremost about just client education. A lot of my clients actually were calling me saying, hey, where can we put more cash into the market when the market's down? So I try to start with that to remind them that say, hey, if we see a stock that we love or we see an asset class we love that's on sale, let's take cash from either our fixed income position or outside assets or cash to actually buy more. For clients who are more panic focused, I think that just starts with controlling the portfolio from the start when you're in a more stable point of view, saying, hey, if we can't weather the storm when things are bad, how do we locate these assets to accept more risk when there actually is some?
Right. And so people are living a lot longer now. I'm sure you have clients who are in their late 80s and 90s. Now, a lot of your clients, are high net worth individuals, but say for the average person, who's going to be in retirement for 20 or 30 years and may even be relying on Social Security at some level.
Certainly.
Because it seems like if you have less than 2.5 in savings, you're probably going to need it at some level.
Absolutely.
How do you manage longevity risk there, so protecting but still providing growth?
I think there are a number of avenues. I would say that I'll be the first to tell you that about 10 years ago, I was one of the biggest annuity haters on the planet because I thought that the cap rates and the way that the products were designed were not very client friendly. But I think the environment now, I think the annuity space is an incredible place for those individuals who might have a tighter or a smaller asset allocation to be able to control volatility and actually plan for income.
And with these longer, retirement horizons and everything too, how do you then adjust when things go sideways or you need to adjust? How do you plan for that?
That can be more tricky, but I think it comes down to, once again, just how we manage a portfolio in times where the market is down. And really understanding that we have at least enough of a benefit base or asset base that we can draw from. I typically tell clients, if you're looking outside of an insurance product like an annuity, that you got to use the rule of 5%. So if you take a look at your entire asset portfolio, let's say that you have $1 million for easy math. You need to have about 5% withdrawn from that per year to have a stable amount of capital to preserve that will last your whole lifetime. So that generates about a $50,000 a year income for that individual. And so it comes down to sometimes the hard conversations, saying, hey, if we've seen a pretty significant drawdown in the assets, do we cut our lifestyle down? or are we able to take assets from other places? Are we looking to, in some of the worst cases, maybe borrow some money? But I think that that's obviously just planning for the short term, so the long term can be a lot more smooth.
I see why your clients work with you. Andrew, thank you.
Thank you, Scott.
Thank you for watching Retirement News Online.